Hi, welcome to the Professional Investment Podcast. I'm Charlotte Moore, award-winning journalist and co-founder of Moore Squared Communications. Each episode we welcome a guest to the show to share their news story of the week, and I'm delighted to welcome Maiyuresh Rajah, Director of Investment at Aviva. Welcome, Mai.
Hi Charlotte, great to be on and thank you for having me.
Lovely to have you on the show. Now do tell us, what is your news story of the week?
Well, Charlotte, my news story of the week is a Pensions Age article titled TPR Outlines Vision for Megafunds and a Simplified Pensions Market by 2036.
And tell us, what was it about this news story that stood out to you and made it your news story of the week?
Well, as you know, Charlotte, there's been no shortage of pension news articles in the press recently, particularly as the Pension Schemes Act received royal assent at the end of April. Now, I know that Steve Webb was on this podcast last week explaining what was in the Act and what it covers, and speaking with you, Charlotte, about the legislative detail behind the Act. And so I didn't really want to go over that again, not least because Steve would obviously do a much better job of that than me. But considering how important that Act is, it's difficult to ignore it when looking at the biggest pension stories of over the week. And then when I came across this article in Pensions Age that covered a keynote speech by Nausicaa Delphas, the TPR CEO, it really caught my eye. And that was because it was focusing on the vision behind this Act. So what's the overall purpose of this Act? What's the destination supposed to look like? What is it that we're actually trying to get to in, say, 10 years? And so it was an interesting way of looking at the Act, which has already been covered extensively in the press. And I thought that investment-specific signals that were covered in that speech and mentioned in the article would be interesting. Would be an interesting angle for this podcast.
Yes, absolutely. It's great to move on from kind of like Steve gave us that great sort of overview of what the Act does and doesn't cover and how much more actually work has to be done to sort of underpin and give that Act bones. But it's great to then go back to the heart of this podcast, which of course is always to talk about investment and think about how that's going to impact us. One of the things that's said in the article is that the debate about where the pension scheme should invest in private assets has been settled, which there might be some in the industry who don't quite agree with, but it's fair to say that most auto-enrolled workplace schemes are in the process of implementing a private asset allocation, putting that in place, making sure they have all the mechanisms and that the back end of the operation works in order to do that. Can you talk to us about what you're doing in that space?
Sure, Charlotte. Yes. So in her speech, Nausicaa Delphas says that by 2036, the debate about whether DC schemes can invest in the long term, in long term less liquid assets will, as she's saying, and you mentioned, be largely settled. But then she actually goes further and says that from TPR's own conversations with schemes, they're finding that some are looking at private markets allocations that go beyond what the Mansion House Accord asks for. Now, from an Aviva perspective, we had already started the move to more private market investing before the recent regulatory focus, as we saw that having exposure to private markets and other non-traditional asset classes is important in getting the best outcome for our customers. So our main DC default strategy, which is called My Future Focus and has over £35 billion of assets under management, has been investing in direct property for many years now. And what we've done over the last 4 years is introduced more private markets investments into that solution to diversify that property allocation. And we've done that by investing in private credit and infrastructure. And that strategy now has around a 10% allocation to private markets across those three different asset classes. And then in October last year, we also launched a new default strategy called My Future Vision, where we worked with our in-house asset manager, Aviva Investors, as well as 5 external private market specialist managers to create a default strategy that invests between 20 and 25% in private markets, depending on where a saver is in their journey to retirement. So when a saver is in the growth stage and not close to retirement, we invest 25%. And as they get close to retirement, that moves down to 20%, which is a significant step up from what you usually see in DC default strategies.
Yeah, I mean, I think there's this joke applied to, I can't remember what exactly, but if you took 7 pension schemes, you'd find 9 ways of investing in private markets. I mean, and that doesn't just apply to private markets, it seems to apply to every area of asset owners and asset managers. If you look at the plethora, the different styles of investing across the pools, across an insurance company, it just seems that we are very good at finding lots of different ways to invest. So could you talk us through, I mean, it can be confusing for those on the outside, for asset managers and the like, trying to get a picture of exactly how all these different pension schemes, whether they're master trusts, large or small, or GPPs, are actually allocating to private assets. Can you give us a flavour of the different routes, and if there's particular characteristics, like do large schemes go one way and small schemes another? What's driving those choices?
Sure. Yeah, you're absolutely right, Charlotte. There are many different ways in which a default strategy can get access to private market investments. Now, if we take a closer look at My Future Vision that we launched last year as an example, you've got the fact that we invest 20 to 25% in private markets, which, as I said, is a significant amount. But what's really interesting is if you dig past that headline number into how those private market investments are being implemented, and that will give you an idea of how we're doing it versus others, and why there's sort of this broad range that you talk about. Now, many default strategies get access to private markets by investing in a single multi-asset fund, so which could be an LTAF, and that can have fixed allocations to a range of private market investments. So just for example, say 25% each in private equity, credit, infrastructure, and property. And then they incorporate that as a single fund, mainly within the growth stage of a member's journey to retirement. Now, that's fine in terms of getting some access to private markets and focusing primarily on one part of a member's journey. But what that means is it doesn't give you the flexibility to invest in different private market asset classes in different proportions and at different times. So what we did with My Future Vision is invest directly in a range of individual funds within each asset class. And then by doing that, we can invest different proportions to different private market investments to take account of the evolving risk that savers face at different stages of their journey to retirement. So if we take a very simple example, in the early and middle years of a member's journey to retirement, we can invest more in asset classes with a higher expected return, such as private equity. Then in the latter part of those middle years, we can still focus on return maximization, but we can also start thinking about how we can help protect the portfolio against severe negative market events. And we can do that by being a bit more diversified in the private market asset classes that we're investing in. And then when a member approaches retirement or when they're in retirement, we can invest in the less risky side of the private markets spectrum, and those asset classes that can also help provide maybe a steady stream of income in retirement as well. So for example, more in private credit. And so that's a simple example of how investing in a range of different individual funds within each asset class can give you the flexibility to build the right investment strategy for savers. And then another important implementation factor is that you can also use a multi-manager investment strategy, which is what we do with My Future Vision, and it uses best-in-class asset management across the private market spectrum. So not relying on the expertise of just one or two asset managers to provide what can be quite a complex mix of different underlying investments. Now, private market investing, as you know, Charlotte, requires specialist investment knowledge and expertise, which means that there can be a wide range of performance outcomes across managers. And so selecting the right manager and the right strategy is incredibly important when looking to achieve strong and repeatable positive outcomes for savers. And so what we've done with My Future Vision is use the expertise that we have with our in-house asset manager, Aviva Investors, and then partner with 5 additional specialist external asset managers who are known for their investment capabilities in global private markets. And what we've also done is use 2 or 3 asset managers in each private markets asset class to enhance diversification and also optimize return potential. So if we take private equity as an example, what we've done there is we use 2 different asset managers with different strategies. And so we can, on one hand, focus, for example, on secondaries, which can give you a quicker return on investments and early cash flows, while on the other hand, we can also focus on things like co-investments, which gives us access to high conviction opportunities with potentially much higher upsides. then, using another example, just sort of bring it to life. If we look at real estate, we're also using two different managers with two different strategies and focus. So we've got one that provides global diversification, and that's across the US, Asia, and Europe. So we have one that provides exposure to sectors like US healthcare, APAC logistics, and European retail, as an example, while the other strategy complements this through high conviction UK exposure. So things like life sciences, energy efficient offices, and also regeneration land. So together they can diversify across regions, sectors, and also styles as well. So you're reducing the reliance on any single market market cycle, and hopefully improving the long-term resilience of savers. So these are all the things that you could do in different ways, and we've chosen a way to go down with My Future Vision, but we know that others do things slightly differently, and there's sort of pros and cons to how they do that.
Yeah, and I was wondering because, you as far as I understood, you haven't taken an LTAF route. That's correct, isn't it?
So in terms of the underlying investment strategies, it's a mixture of LTAFs and OICs and CCAFs. So we haven't gone with one route. So what we've done is looked at the underlying investment strategy and decided what's the best strategy for that solution. And then we may pick an LTAF or an OIC or CCAF or something else from that perspective.
Okay. But I wondered, as time goes by and as all of these pension schemes become larger and more consolidated and they have to hit their 25 billion, and I know obviously for you guys you're already there. You may not be if you look at the pure master trust, but if you look at the default fund, if you wrap in the GPP2, you are already there. Are we going to see people move away from using structures like that and towards segregated mandates, Nest, because you will be big enough to be able to do that? Or do you think, so is there going to become less difference in how people approach the actual operational side of it? As schemes become larger and more consolidated, or do you think we're still going to see a diversity of approaches? And on the flip side, as people get larger, and when we're talking about private assets, we're really talking about taking advantage, of the small company effect and being able to invest in smaller companies that are on growth trajectories. Is there a danger we get too big that just doesn't become a possibility at all for pension schemes because they're so large that investing 2%, they only ever want to invest 2% of their portfolio, and 2% is still so big that you can't do venture capital or anything else? How do we manage that? How do we keep things fresh and innovative and not stale and moribund and too big?
Yeah, so I'll try breaking that down. There is that potential issue that consolidation continues, and we get to mega funds of significant scale, managing hundreds of billions of pounds, and that when they get to that size, they'll obviously need to deploy capital at scale. And investing in a few million pounds, say, for an interesting mid-market private equity manager or niche infrastructure fund will barely move the needle when it comes to the overall portfolio. And so the sheer scale of these mega funds, given some time, will mean investing mainly in those sort of large private markets managers that can absorb the check sizes required. So, that's a very valid concern that you're outlining there. But when we get to that stage, a few things can help. So, for example, that multi-manager model that I mentioned is one way that we can look to help with that. So, as scale increases, you can use a multi-manager approach to create a sort of a natural architecture for tiering. So, you can have your core allocation to large, well-capitalized managers with the capacity to absorb significant commitments, while on the same point, at the same time, you can have a satellite allocation to a number of smaller, more specialist managers where the return opportunity is more compelling, but the fund sizes may be smaller. So as things evolve, that's one option. But even before you get to that sort of point when scale is so big that you can create that tiering, working with the right pool of asset managers right now will help ensure that those sort of innovative and groundbreaking investments that you're talking about do make it into portfolios. As if they're doing their job properly, they should be investing in those types of opportunities. And this is where the governance structure around the investment managers and the due diligence that's carried out by the default solution provider is going to be so key. So you're picking the right managers that have the partnerships, the connections, the ways into the more innovative and interesting investments. That could be the next big thing and really help customer outcomes as well as generating growth for the economy. And I know one of the things that we've sort of talked about in the past is what can small boutique asset managers in private markets do about this now. And a plan could be to make sure you're properly aligned or partnered with these big asset managers as specialized, if you like, sub-investors in specialist areas. So things like local regional growth or niche technology sectors or renewable energy projects that these larger firms may miss.
Yeah, I mean, you don't want your fund of funds to become like a series of nesting Russian dolls, right? That you just keep peeling out, going smaller and smaller and smaller, which, might be great because you get to a teeny tiny fund. But, in between each nesting Russian doll would be a layer of fees that you don't want. But at the same time, we need to have some kind of flexibility to allow these new ideas to come to the surface, because it would be a shame if that all got killed off too. And that's not in the spirit of investment, is it? I mean, investment is supposed to be. Microsoft might have been in the top 25 companies for I think it's the last 25 years or something, but we do like the idea of innovation and new coming through, and you never quite know what the companies of tomorrow are going to be. So you need an opportunity to be able to invest in that. So I think maybe the advice for a small asset manager is you can't physically have enough partnerships, right? You can't have enough strategic alliances, whether that's with other asset managers that then have the relationship with the asset owners, trying to have those relationships with the asset owners. We're kind of moving into an era of cross partnership, aren't we? Between managers and owners, and even between owners, maybe not just at a domestic, but at an international level as well.
Yeah, absolutely. And I think that's the way that we can really bring out the best outcomes for customers, right? So we get access to those sort of niche and smaller private market investments. But the way to do that is through these sort of large asset pools where you've got the governance and the liquidity to be able to do these sort of things. And like I said, I touched on earlier, that's where the governance of the default default investment solution provider becomes really important, because they're the ones that are going to have to look at these investments, talk to the main asset manager in one asset class, who's then looking at these sort of sub-advisors and making sure that they're doing their job properly, and also making sure that layering of fees isn't getting to a point where it's not right for the underlying customer. So these are the things where you really need a well-resourced, well-governed default solution provider to oversee the overall structure.
Yeah. Okay, that's really fascinating. Let's just move to another area that Steve Webb actually touched on, and I'd like to get your thoughts on this. One of the things that's come out of the Pension Scheme Act is that you will now have this contractual override, which will allow people like you who have lots of legacy schemes, and we sometimes forget, don't we, because we get caught up in auto-enrollment, that actually there are a lot of DC schemes that date back to the 1990s when DB began to fall out of favour. And certain industries, like I think pharmaceuticals and investment banking and financial services, had DC for a very, very long time. But we had this issue where there were a lot of assets stuck in legacy schemes that probably not serving those members' interests in the way that they could. What are you excited about that contractual override allowing you to do as a director of investments?
Yeah, sure. So it's a really interesting topic. So the contractual override provision is probably one of the less discussed, but genuinely really important provisions in the Act. Now, the problem it's trying to solve, as you mentioned, is there's these lots of people in contract-based pension arrangements, and a lot of those arrangements do have older, outdated funds, structures, and systems. But because they're contract-based, where the provider of the pension arrangement has an individual contract with each person, it is very difficult for the provider to improve that situation that the individuals are in, as will mean renegotiating the individual contract or getting individual consent, which are practically very difficult and very slow to do at scale from a provider perspective. And so what this has meant is there's been this long tail of people sitting in outdated strategies and solutions. So as an example, from an investment perspective, they could be in a lifestyle strategy that de-risks into cash or gilts, which may have made sense when annuity purchase was the expected retirement outcome, but may no longer be the optimal strategy in the sort of post-pension freedoms world. And so the contractual override provision gives providers like us the ability to move these individuals en masse to better strategies through a structured governance process without needing that individual consent. And for the GPP market in particular, that could be really transformative. And providers with large legacy books can now rationalize their default range and migrate customers to strategies that are more appropriate in terms of modern retirement outcomes, better performing funds, and better positioned under the new VFM framework. So all very, very important for the individual as well as the provider. And the people that will benefit most from an individual perspective are precisely those who've been stuck in these legacy schemes and are least likely to have engaged actively with their pension scheme. So this is a really important provision.
Yeah, I mean, there's so much we can talk about in the bill, and we're only going to do half an hour, but maybe the other big area that there's still an awful lot to iron out on is the provision of retirement income. That you need to provide a simple solution at retirement and you need to have a default solution at retirement. I think the industry is fairly kind of united in its thinking about what that solution looks like, that it should be about drawdown up to the age of about 75 when people legitimately can start to worry about their money lasting their lifetime and some kind of annuity kicking in to give that kind of longevity protection, which somebody like you as a large insurer with a big book of mortality would be much better able to manage that risk on behalf of the member than an individual trying to shop around for their own annuity. So how are you thinking about retirement income? Do you feel like it's obvious what needs to be done? Are you still waiting for more detail from the government legislation? Is there things you need to know the answer to? How's your thinking evolving around that?
So, I mean, from an Aviva perspective, as you'd expect, we look at how to help DC retirees, all the time, and we did quite an in-depth research into what people actually want from their income in retirement. And when we did that, we started to see slightly competing requirements that people want. So firstly, people want flexibility. So they want that flexibility that they got from pension freedoms all those years ago to do what they want with their retirement savings. But they also want an income that lasts. So they need that security as well. And then thirdly, they also want a level of predictability with their income. So as I said, a number of slightly competing but understandable requirements. Now, the added issue we have is that when people get to retirement, they're also unsure about how to make best use of their pension pot. So on the one hand, we're starting to see people withdrawing too little and not having, not living as well as they could in retirement as they're worried about running out of money. While on the other hand, we're also seeing some people withdrawing too much money and using their pension pot too quickly as they can't work out how to make their money last. So there's a big issue around people using their pension pot effectively. So the challenge that we looked at solving is how we can help people manage their money effectively and give them the flexibility, security, and predictability that they want in retirement. Now, the way we thought we can help people solve this, and we've been working on a number of years now, and we launched a solution that does this in this last summer, so in the summer of 2025, is by effectively splitting a person's retirement into two distinct phases. So the sort of phases that you touched on, Charlotte, an early part of the retirement where members will have the flexibility they want, and then a latter part of retirement where they'll have the security that they're obviously going to need. And that was the principle behind this Aviva guided retirement solution that we launched last summer. And what it does, it gives retirees a period of flexibility during that early year. So, you mentioned 75, we've got it up to 80, and then security in the latter years. And it does that by combining a drawdown solution with an annuity. But it also has this occasional spending pot that people can dip into if they need more money on top of their regular income. So there's sort of three pots at play here. And we'd sort of already designed and progressed that solution long before there was an indication that the Pension Schemes Act, or the bill as it was previously called, might include a default retirement income solution. But looking at what's required under the Act, this type of sort of flex first, fix later solution that you touched on could work really well in this space. And I know that other providers in the industry are now looking at this type of solution as well. So it is something that's becoming, I guess, universally accepted, if you like, by a lot of stakeholders in the market. And like I said, we started working on it a number of years ago. We launched it last year, and we think it is the right solution to help savers.
And I just wonder, in all of this, is there anything that's making you really feel excited about being able to invest in or do more of than you have done in the past, whether that's on the private asset side or within the retirement income approach? And if anything you mentioned could, actually have a picture, that'd be wonderful. You can think of something tangible to invest in, because the delight of doing a professional investment podcast is every week trying to think of a picture to illustrate.
Okay, I'll have a think about the things.
So something tangible that you're excited about investing in. Whether that, and obviously probably not an annuity then, because it's not very tangible, is it? And it's underpinned by gilt. So
no, but then I think we're at that position now where annuities, people are starting to again see the benefit of annuities, right? So it might not be tangible in terms of you can't touch it, but it is tangible in terms of being of great use to individuals. And it's really positive that we're coming round to that way of thinking. And when we created Guided Retirement, we did look at a lot of research and spoke to lots of individuals. And I think people know this, that they might not want an annuity, but when you talk about the benefits of an annuity, it's exactly what they want, right? So they want security, and by splitting it into splitting their retirement into two different periods, you're giving them the opportunity to benefit from this annuity type phase when they actually really want it. So I think it is getting to that position when it is being seen as worthwhile by individuals. Is just basically explaining it to them in a way that they understand. And so I'm quite excited about that, because I think I feel there's always been a place for an annuity. And we've been talking about it for a number of years in terms of this drawdown and annuity solution. So it's good to see that it is becoming sort of universally accepted, because I feel like I've been talking about it for years now. On the private market side, sorry.
That's not helping me in my illustration at all. Now I'm going to have to just put a chart up of bond yield or something.
Bond yield, that's right, yeah. Or maybe just as they've done in the past, old people in linen walking towards the sunset.
I know. I haven't yet
stay away from that.
Yeah, exactly. Yet to succumb to such obvious picture choices. So yes, private markets. Is there something?
Private market. Yeah, so private markets. Some of the things that we're looking at and our in-house asset manager, Aviva Investors, is doing a lot of work in the space, and that's why we're really happy with the way we've structured the solution, where we've got Aviva Investors and then we've got these other private market asset managers for My Future Vision. And as I mentioned, with Aviva Investors, you're looking at these sort of UK focused growth initiatives, where they're looking at these sort of tech startups, healthcare initiatives. And so there's lots of things there that we're doing, which do feel like they will benefit individuals who invest into this fund, but also benefit individuals who live in the UK, not just from a productive finance perspective, but as a sort of from a medicine perspective, from a growth perspective, in terms of trying to actually improve the lives of the people that we serve. And I'm sure we've got lots of pictures I can share with you around those sort of investments where we've gone into that sort of the healthcare market and tried to look at these sort of initiatives that can hopefully increase life expectancy, for example. So yeah, lots of interesting and exciting stuff that's coming on. And this act does give us that ability to do more in that space, right? So it does open up the ability to have default funds which look at value rather than cost, and so can invest in this, which is historically been regarded as expensive investment. So these are things that we are really excited about and are tangible, and I'm sure I can find a picture for you from it that you can use. I
can now. I can find a picture. I've already got one in mind.
You've already got one in mind, right? Brilliant.
Yeah. So, which is, I think that point about kind of using your pension in order to invest in a drug or a medicine or a therapy that might help to improve and your longevity and your quality of life as you age has a nice circularity to it. So with all of these different things that we've talked about, how do you, the thing that's nice about working in this industry compared with other bits of the financial services sector, I would say, having worked in other areas before, is that I think it's fair to say that this industry is united by a common sense of purpose. We're all in it in order to help people have a good retirement. Everybody knows that that's their purpose, wherever they are within that investment chain. So how do you think all of these changes that we've been discussing, that, all these investment implications of the Pension Scheme Act, how is this all going to benefit members, using maybe that example of investing your pension in order to improve your longevity as a jumping off point, maybe?
Yeah, I mean, I guess we could probably take a step up from that, really. I think, the majority of the Act and everything we've discussed today is trying to attack the problem of getting better retirement outcomes for people from both sides, if you like. So on the accumulation side, you're looking for better returns through private markets, more scale to negotiate better terms with managers. You've got the BFM pressure to stop accepting sort of mediocre performance for the sake of low charges. And all of this should help build retirement pots for people. And then on the decumulation side, you'll have that guided retirement pathways that should help people make better decisions with the money that they've accumulated. So, like I said, research shows us that people are, can underestimate how long they're likely to live, overestimate the suitability of cash, and also struggle with the complexity of drawdown. How much money am I going to take out to make my pot of money last? And a well-designed default retirement pathway doesn't automatically solve all of that, but it can provide a professionally managed and governed structure that people can use to help manage their money effectively. So, bringing that all together, I think if it's implemented well, the pension saver in 10 years' time, which is what the sort of article, bringing it back to the article that we talked about at the start, focuses on, could be in a substantially better position than a saver today.
Okay, well, thank you so much for all of your insights and for that wonderful conversation and for navigating your technical difficulties as well. I know what it's like. I just want to say thank you so much for being a fantastic guest on the show, Maya. It's been lovely to have you here.
It's been great, Charlotte. Thank you for having me. And apologies about the technical issues that we had, but hopefully no one saw that on the podcast, so we'll be okay.
We'll be okay. And listeners, if you want to make sure that you never miss a future episode of the Professional Investment Podcast, then make sure you hit that subscribe button and do interact with us. Take part in the poll if you're listening via Spotify, and feedback your comments. Thank you for listening.